Good day, ladies and gentlemen. Welcome to Vista Gold's Feasibility Study Results Conference Call and Webcast. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session. At that time, participants are asked to press star 1 to register for a question. For assistance during the call, please press star 0 on your touch-tone phone. As a reminder, this conference is being recorded today. It is now my pleasure to introduce Pamela Solly, Vice President of Investor Relations. Please go ahead.
Thank you, Julie. Good day, everyone, and thank you for joining the Vista Gold Corp Investor Conference Call and Webcast. I'm Pamela Solly, Vice President of Investor Relations. On the call today is Fred Earnest, President and Chief Executive Officer, Doug Tobler, Chief Financial Officer, and John Rosell, Senior Vice President. During the course of this call, we will be making forward-looking statements. These statements involve known and unknown risks, uncertainties, and other factors that may cause actual results, performance, or achievements of Vista to be materially different from results, performance, or achievements expressed or implied by such statements. Please refer to our most recently filed Form 10-K and Form 10-Q for the notes regarding forward-looking statements and details of risks and other important factors that could cause actual results to differ materially from those in our forward-looking statements. Today's presentation has been posted to the Vista Gold website at www.vistagold.com. I'll now turn the call over to Fred Earnest.
Thank you, Pam, and thank you, everyone, for your interest in Vista Gold. Completing the Mount Todd Feasibility Study with the exceptional potential it demonstrates is among the most important milestones that we have achieved in bringing Mount Todd to a development-ready stage. We believe Mount Todd's location, scale, project economics, permitting status, and the extensive technical work completed represent a unique near-term development opportunity and allow us to evaluate a broad range of development partners, structures, and alternatives as we continue to focus on maximizing shareholder value. The feasibility study affirms the strength of Mount Todd's gold production capacity and ability to deliver solid economic results at a time when inflationary pressures are having significant impacts on operating mines and development projects alike. By using fourth quarter 2021 quotes and costs, we feel this feasibility study fairly reflects recent market conditions. All of the work that we have completed creates valuable optionality in the approach to its development. There are a couple of important improvements in this study that warrant mentioning. First and foremost, gold reserves increased by 19% and now stand at 7 million ounces. As a result, payable gold is estimated to increase by 1 million ounces over the preliminary feasibility study completed in 2019. This alone is an exceptional demonstration of the underlying value we expect to unlock. The Mount Todd economics also benefit from our decision to have a third party build, own, and operate the power plant. In doing so, we have achieved capital cost savings and eliminated a number of construction and operating risks while retaining attractive operating costs. The feasibility study distinguishes Mount Todd as a unique development opportunity. Our attention will now focus more intensely on increasing shareholder value and realizing the intrinsic value of Mount Todd. We have confidence in the prospects for accomplishing these goals as we look to a broad range of potential partners, structures, and alternatives that are possible with the Mount Todd feasibility study now complete. I think that it would not be an unfair statement to say that Mount Todd is a world-class development stage opportunity in Australia. Not only is the feasibility study complete, but all key operating and environmental permits have been approved. The project demonstrates exceptional scale with, as I mentioned, over 7 million ounces of proven and probable reserves. Life of mine average gold production of 395,000 ounces per year. And over the first 7 years, the average production is 479,000 ounces per year. We have a 16-year mine life and multiple targets for extension of the life of the project. With an $1,800 gold price, the project clearly demonstrates robust project economics. The after-tax net present value at a 5% discount rate at that price is $1.5 billion with a 26.7% IRR. Our all-in sustaining cost of $860 an ounce over the first 7 years certainly provides ample opportunity for payback. We believe that the project is de-risked and development ready. We have selected modern, efficient, and industry-proven equipment as part of the process design. The existing infrastructure provides immediate benefits, and the site location is exceptional, one of the most easily accessible projects in all of Australia. Importantly, we believe that our social license is strongly in place, both locally and with a broader constituency of NT residents and government officials. Let me delve into some of the summary of the details of the feasibility study. As I indicated, proven and probable reserves have increased by 19% and now total 6.98 million ounces of gold. That's contained in 280 million tons with an average grade of 0.77 grams of gold per ton. Interestingly, while that's the feed to the primary crusher, post-sorting, the feed to the grinding circuit will average 0.84 grams per ton over the life of the project. Our reserve estimates, as John Roselle will explain in more detail, are conservatively based on a $1,125 gold price and a 0.35 gram per ton cutoff. As I mentioned, the economics reflect fourth quarter 2021 costs, and we feel they appropriately represent and reflect the inflationary increases that our project and others have seen. At the official price of $1,600 and a 71-cent foreign exchange rate, the after-tax NPV at a 5% discount rate is estimated to be just shy of $1 billion, with a 20.6% IRR. At $1,800, the after-tax NPV5 is $1.5 billion, with a 26.7% IRR. The initial capex has increased 8% since our last study and is now estimated to be $892 million. That reflects a capital efficiency of $141 per ounce, which is much better than many of our peers. Looking at the first 7 years of the project, the average annual gold production will be 479,000 ounces. Average cash operating margins of $406 million per year, while average cash costs are $752 an ounce, and our all-in sustaining cost over the same period is estimated to be $860 per ounce. Interestingly, after-tax cash flow will total $2.1 billion at an $1,800 gold price over the first 7 years. Obviously, this represents tremendous opportunity for payback and shareholder returns. As I indicated, we've made the decision to have a third party build, own, and operate the power plant. This has the benefits of insulating the project from certain capital, construction, and operating risks. All of the project designs align with the approved mining management plan and the environmental authorizations received to date. Of note, because of the increase in the size of the project, we will be filing for certain amendments to the mine management plan in the near future. Looking at a little bit more detailed summary of the feasibility study results, I'm going to turn the time over to John Roselle.
Thank you, Fred. As shown on slide 5, you'll see that the initial capex is $892 million, as Fred said. Sustaining capex over the life of the project is $663 million. The project is designed at 50,000 tons per day, or 17.75 million tons per year, which is consistent with past projects. Gold grade in the first 7 years will average 1.01 grams per ton to the grinding circuit, and for the life of the mine, as Fred said, 0.84. Gold recovery in the first 7 years is expected to be 92.2%, and for the life of the project, 91.6%. We have a reasonable stripping ratio at 2.51, slightly higher in the first 7 years at 2.77. Operating costs per ton milled in the first 7 years will be approximately $20.28, with $18.40 over the life. Payback is 47 months, as Fred has indicated. NPV 5 at $1,600 gold and 0.71 is just shy of $1 billion, and our after-tax IRR is 20.6%. We'll turn our attention now to how we increase the proven and probable reserves. I want to start by stating that we have not changed the resource as it has been reported previously. We still have the same resource quantities in measured, indicated, and inferred, and obviously only measured and indicated translate into proven and probable reserves. As Fred indicated, we've had a slight change from before in that we moved from the $1,000 gold pit in the 2019 study to a $1,125 gold pit. Still a conservative number for determining the reserves present. They've also had a slight decrease in the cutoff grade. We've moved from 0.4 gram AU per ton to 0.35. This cutoff grade is still well above the internal cutoff grade, still allows a reasonable margin on each block mined for profit. And I would note that the 0.35 gram will report as nearly 0.4 gram to the grinding circuit. So it's not an unreasonable change. This has resulted in a greatly improved production profile, so that we have a very strong initial 7 years. We do have a slight dip in years 8, 9, and 10 due to a stripping spike, and we believe we can fill that stripping spike from both addition of or conversion of input resources to reserves and additional exploration. And also we finished with a 16-year life, up 3 years from previously. As you can see, we have a very strong gold production profile on slide 7, and it is indicative of the positive aspects of the Batman deposit in particular. I would add that, as we've talked about, we are still open with regard to looking for exploration in and around Batman and extensions, and we believe that the dip in production in years, 9, 10, and 11, I said 8, 9, and 10 previously, I apologize. 9, 10, and 11 can be filled in well ahead of when we get to that point. Slide 8 gives you the layout of the project. The layout in general is unchanged. We still have 2 tailing storage facilities in the exact same places as before. Obviously, the pit is in the same place as before, slightly larger because of the change. The waste rock dump has grown in size. We've added to the south on the waste rock dump, and that'll be one of the areas that we must amend in the mine management plan. The plant area is still in the exact same place, as well as the configuration of the plant is unchanged. When we talk about the process plant, we have a very compact, well-organized process plant. The flow sheet is unchanged from before. It is the same components, all off of the shelf and readily in use today in the mining industry. We've had the ore sorting, which we have talked about in the past. The ore sorting reduces our feed to the grinding circuit post the HPGR, or post sorting, by approximately 10% with only a 1% ore loss. It provides a substantial benefit in the grinding circuit. 2-stage grinding to the 40 microns, still very quick recovery with a 24-hour recovery cycle within the leach plant. The feasibility, or the process plant, is now at full feasibility stage with the completion of the piping, the electrical, the instrumentation. In addition, we completed geotechnical investigations for the foundations of the heavy equipment within the process plant, for buildings, for the tailing storage facilities, the waste rock dump, and those have allowed us to tighten up our material takeoff estimations and improve the costs based on that. Turning to slide 10, as we have talked about, we have completed a third-party trade-off study for the providing power to the site. The study identified well-capitalized power providers in Australia that are currently providing power to other mining operations. The third-party power supply does allow us to take that part of the CapEx risk away and give it to someone who it's their main business, and yet we've managed to negotiate a very attractive price with regard to power for the plant, and it will be a dedicated power plant. With that, I'll turn it over to Doug Tobler, our Chief Financial Officer.
Thanks, John. I'd like to take just a few minutes to drill down on several highlights of the project economics. First, if you'll look at slide 11, this slide presents a comparison of the project revenues to cash operating margins. We prepared this slide using a $1,600 gold price. We use this chart to illustrate the project's economic performance potential by looking only at our site-based inputs. As you can see, Mt. Todd has very robust cash operating margins. Of key importance is the project's ability to produce high margins in the early years of the project. In total, the margin for years 1 through 7 is $2.8 billion. Year 8 is still very strong, and then we move into a couple years where we're reinvesting in the project. By that I mean, and this is what John mentioned, we'll be pre-stripping areas of the deposit to provide access that will allow us to meet our production rates in the later years of the project. And John has mentioned several opportunities that we have confidence in provide us the potential to strengthen margins during this period. Once this period is complete, we then return to high margins for the balance of the mine life. This last third of the mine generates additional margins approaching $2 billion. Having this sort of cash flow in the latter years of a mine is another distinct advantage of Mt. Todd. Now moving on to slide 12, here we put the entire project cash flows together and present them on an after-tax basis. Again, we've run this chart assuming a $1,600 gold price. The left axis represents the annual cash flows, and then if you look at the right axis, that illustrates the cumulative cash flows. And without belaboring the annual details, you can see that in year 7, our cumulative after-tax cash flows peak at just over $2 billion. And I'll talk more about project sensitivity to the gold price next, but it's worth noting that on this chart, the cumulative after-tax cash flows would peak at $2.8 billion if we run the same chart using the $1,800 gold price. And finally, moving on to slide 13, here we presented the project sensitivity to the gold price. On the left, the project's net present value progresses from $1 billion at the $1,600 gold price up to $1.5 billion at a spot gold price of $1,800. That works out to about $230 million of NPV benefit for every $100 increase in the gold price. And by similar analysis, on the right-hand side, the internal rate of return shows an increase of about 3% for every $100 increase in the gold price. With that, I'll turn the presentation back to Fred. Thank you.
Thank you, Doug and John, for discussing the details of the Mt. Todd project and the results of the feasibility study. We believe that there are yet opportunities for adding value at Mt. Todd. One of those lies in the price of natural gas. We believe that as we're able to make a definitive investment decision and commit to a long-term take-or-pay contract, that we'll be able to achieve a significantly better gas price than that which we have used to estimate power costs in the feasibility study. Additionally, as John has alluded to, there's the opportunity to convert inferred resources that are presently found within the current ultimate pit and presently accounted for as waste. These could have the opportunity to, or present the opportunity to extend the life of the project by possibly up to a year. The Batman deposit demonstrates modest increases in gold grades with depth, and the deposit is open at depth. A significant increase in the gold price could justify further expansion of the pit at depth. The Quigley's deposit, where we report a small, higher grade mineral resource at the present time, could also be a source of additional material for a little bit longer in the life of the project. Additional drilling and metallurgical testing is needed to develop mine plans and convert the Quigley's resource to reserves, but it could be an additional source of feed to the plant in the midlife of the project. Recent drilling, which has confirmed the continuity of mineralization between the Batman and Quigley's deposits, demonstrates the opportunity for additions to the mineral resource inventory within the boundaries of the mining license. And then, outside the boundaries of the mining license, within our exploration licenses, which total over 1,500 square kilometers, we see a very important opportunity to add resources in the future. Our exploration licenses lie at the southeast end of the Pine Creek district, a gold mining district that has produced gold for over 100 years. We have identified a number of gold targets, but have not advanced to drilling many of these targets. We believe that with future drilling, there's a strong opportunity for growth in the life of the project and in resources through exploration. I think it's important to talk about some of the differentiators between Mount Todd and other projects and what sets Mount Todd apart. While we've not listed it on this slide, I would like to point out that I think that one of the key differentiators is our people. Both the corporate staff and our staff at Mount Todd are exceptional mining professionals with years of experience. Our Australian team has done an exceptional job of earning the trust of the community and ensuring that our social license is firmly in place. We believe that the Northern Territory of Australia is a great mining jurisdiction, certainly a Tier 1 mining jurisdiction, a jurisdiction where mining is understood and encouraged. The location of the project, its climate and geography are well suited to productive year-round operations at only 100 meters above sea level. And with no freezing temperatures, we do not face many of the challenges that some of our peers face with regards to climate and geography. As has been noted, all of the major permits for construction and the operation of the mine are approved. Our environmental impact statement was approved by the Northern Territory Environmental Protection Agency in 2014. Subsequently, we were required to seek authorization of a federal environmental authorization under the Environmental Protection and Biodiversity Conservation Act. That authorization was received in January of 2018. This past summer, in June, we received approval of the Mining Management Plan, the equivalent of a mine operating permit here in North America, from the Northern Territory Department of Industry, Tourism, and Trade, of which the Department of Mines is a subset. Subsequently, we have received other mining permits, including our water extraction license that allows us to take water from the freshwater reservoir, the waterway diversion authorization, which will be required as we realign a couple of creeks, and also Aboriginal Areas Protection Authority certificates for both the mining license and the exploration licenses. We have worked hard to establish and maintain a strong relationship with the Jawoyn Aboriginal people and their leaders, and consider them to be long-term friends and supporters of the project. As we've discussed, the all-in sustaining costs for years 1 through 7 are exceptional and are well below the median all-in sustaining costs for junior and mid-tier producer peers. We enjoy significant infrastructure, paved roads, a power line, natural gas pipeline, tailing storage facility, and freshwater storage reservoir. These infrastructure items significantly reduce the project development risk and shorten the project development timeline. As I indicated, our all-in sustaining costs are well below the median for both junior producer peers and intermediate mid-tier producer peers. You see in both of these charts that the $860 per ounce all-in sustaining cost for the first 7 years of the project is below both the median for junior producers of 1,076 and the median for intermediate producers, which their median is 1,047. Obviously, this makes the project very attractive as a partnering opportunity for a senior producer or an upper mid-tier producer, and we believe that this is a distinct advantage of the project as well. In conclusion, allow me to address why we believe that an investment in Vista Gold is merited at this point in time. Vista Gold continues to be undervalued, and even though our share price has increased since the announcement of the feasibility study results, there's still considerable opportunity for growth in value. We have a clear path to value realization. This is made possible by the feasibility study results with its 19% increase in the proven and probable reserves, which provide compelling economics over a 16-year mine life. The feasibility study demonstrates resilience to current inflationary trends. The project is located in a safe and friendly mining jurisdiction, that of the Northern Territory of Australia. It's fully permitted and is easily accessible. In fact, one of the most easily accessible mining projects in all of Australia. The work that we have completed provides valuable optionality for the development of this project. It's large scale with high operating margins and is positioned to be one of the largest gold producers in Australia. We've talked a little bit about our work with the Jawoyn Aboriginal people and the strong support that we enjoy from them, and the fact that we believe that our social license is firmly in place. Additionally, Vista Gold is recognized in the Northern Territory as a leader in environmental stewardship as a result of our water management activities. We have laid the path for value creation. The completion of the feasibility study marks the completion of one of the first and important milestones. We will now turn our attention to increasing shareholder value as we pursue a wide variety, a broad range of potential opportunities and structures as we seek to unlock the value of Mount Todd. This concludes our presentation this morning. We'd like to thank all of you for joining. If you need additional information, I invite you to reach out to us and contact Pamela Sully, our Vice President of Investor Relations. With that, we thank you all for joining us and wish you all a very pleasant day.
Ladies and gentlemen, this concludes today's conference call. Thank you for participating. You may now disconnect.